Okay, so today I'm going to talk about something that's a little bit embarrassing for a finance channel. For about 5 years, I honestly spent thousands of hours trying to beat the market. Reading annual reports, watching the news every morning, and building spreadsheets I was weirdly proud of. All so I could pick stocks that I was sure about. And then I compared all that effort to a boring 3-fund ETF portfolio I could have set up in an afternoon. And honestly, that made me realize I wasted so much of my time. In fact, over the last 5 years, my boring ETF portfolio has significantly outperformed my individual stock picking with next to none of the effort. And before you ask, the portfolio is simply VAS, VGS and IVV. And I'll show you the exact allocation later on. But first, I want to cover why something this simple works so well. Now, some of you are living this right now. The research version of me thought that investing was a skill that you could grind. Like playing a video game, put in the hours and you'll get better results than everyone else. So a typical week for me was reading business reports for companies that I owned or thought about investing in, watching the market open and refreshing my portfolio way too many times during the day. I mean, what was that going to achieve? And so many spreadsheets. I had spreadsheets analyzing my spreadsheets. And here's the thing, it felt productive. I felt like I was being a serious investor. And that's the trap. Effort feels like an edge. But I want you to sit with one uncomfortable question, because this question redefined how I think about investing. If thousands of full-time professionals with dedicated teams of analysts and every resource known to man can't reliably beat the market, what made me think I could, doing it on the side after work? And this is the part where I stop talking about my feelings and show you the receipts, because the data on this is crystal clear. The game's not even close, it's a blowout. Every year, the Dow Jones indices publish something called the SPIVA scorecard. That's S&P indices versus active. It's been running for over 20 years, and it does one simple thing. It checks how many professional, actively managed funds actually beat their benchmark index. And there's an Australian one, so I'm not just bending US data to fit here. These are funds buying Australian shares measured against the Australian market. Over the last 15 years to June 2025, 85% of actively managed funds failed to beat the ASX 200. That's the index they're trying to beat. And it gets a lot worse for the global guys. Funds focusing on international shares, 94% of them underperformed. Over 15 years, 96%. I mean, read that again, 96%. That means roughly 1 in 25 fund actually managed to outperform the index they're actively trying to beat. The other 24 charged investors a fee to get worse results. And the SPIVA authors put it bluntly. Over that decade to June 2025, in every single category, the majority of actively managed funds lost to their benchmark. Now the smart pushback, and look, it's a fair one. Jeremy, some funds do manage to beat their indexes, so I'll just buy those. Look, I thought that too, but I'm going to show you why that doesn't work either, and what led me to retiring my wonderful spreadsheets. The S&P also tracks something called persistence. Basically, do the winners keep winning? In 2022, 127 actively managed funds beat the ASX 200 index. Safe to say, that's a cracking result. And then I found the one statistic that retired me from stock picking. Of those 127 winners, how many do you think beat the market in 2023 and 2024? One fund. So even if you've done all the right things, backed the right horse, the chances are over the long term, it's a coin flip whether it's going to make money or not. And that coin flip is weighted heavily against you, because past winning tells you almost nothing about future winning. And here's the absolute kicker that most people miss. More than half those funds didn't even survive 15 years. They got merged or simply shut down for poor performance. The losers quietly disappear, and the track record that you see is already flattering. That's survivorship bias baked right in. So if the pros can't do it, why does a simple ETF portfolio quietly win? It comes down to 4 things, and honestly, none of them are clever. 1, fees. An actively managed fund might charge you fees anywhere between 0.5% to well over 1%. In contrast to a simple ETF, that same fee structure can be as low as 0.04% to sort of 0.2%. Now that gap may not sound like much, but when you compound your returns over 30 years, the difference is staggering. Literally hundreds of thousands of dollars. You're not paying for performance, you're paying for activity. 2, behavior. Now, this is the big one and probably the one I'm most guilty of. The more I researched, the more I fiddled. The more I fiddled, the more I thought I was doing the right thing, trying to buy more when I thought things were cheap and sell when I thought things were overvalued. But all that did was lead me to try and time the market. And look, I did. Consistently badly. Every trade I did gave me the opportunity to do something wrong. The simple portfolio gave me nothing to fiddle with, which protected me from my worst instincts. 3, time. Even when my research was good, it cost me hours that I'll never get back. My ETF portfolio takes 10 minutes a month. The honest return on effort isn't even close. And 4, diversification. My stock picks were a handful of bets. One broad market ETF can hold hundreds or thousands of different stocks. When you own the whole market, you don't need to be worried about which company is winning or losing. You just have to be right that the economy over decades is going to grow. And that's a much easier bet. So here's the portfolio that beat all of my effort. And I want to be upfront. This is what works for me. Don't just blindly copy it. Do your own research. Go speak to a qualified financial advisor before doing any of this. But here it is. A broad Australian shares ETF to give me exposure to my home economy. For me, that's VAS with a 20% weighting. A broad global international ETF for everything else. For me, that's VGS with a 60% weighting. And one with direct exposure into the US markets. For me, that's IVV with a 20% weighting. And yes, there's some overlap between VGS and IVV. For me, I wanted some additional exposure into the US because that's where a lot of the world's largest companies are. You absolutely don't need to do this. It's just something that works for me. Over the last 5 years, my ETF portfolio has returned about 12% a year. My stock picking portfolio, closer to 9 or 10%. The gap isn't massive, but my ETF portfolio won with almost none of the time invested. And that's it. I've set my portfolio up so I automatically invest each month when I'm paid. And the rest of the time, I genuinely don't look, which after many years of constantly refreshing my investment account has weirdly been one of the most satisfying things. Now, this is the part that most channels skip, and honestly, it's the most important part. A broad market index can still go down, and sometimes hard. ETF investing isn't risk-free. And just like the actively managed funds, past performance doesn't guarantee any sort of future performance. And that applies to my portfolio as much as the actively managed funds I was bagging out earlier. And if researching companies is genuinely a hobby that you enjoy, absolutely do it. Just be aware that the statistics are against you, and perhaps you want to balance any individual stock picking with an ETF portfolio of your own. The point of this video isn't that research is bad. It's just that for most of us, wealth building was never meant to be hard or clever. We were just sold the idea that it should be. The data suggests that a simple low-cost ETF portfolio has outperformed the majority of active funds over the long term. Simply, you don't need to be a world-class investor to get world-class investing outcomes. What does your ETF portfolio currently look like? Chuck it down in the comments below or feel free to roast mine. Thanks for watching, and I look forward to seeing you in the next video.